Gold just broke the kind of pattern that doesn't unbreak, and the market is already trying to talk you out of what your eyes just saw. Because the moment you treat this as a real regime shift, a lot of comfortable narratives stop working. The loud crowd will say it's hype. The cautious crowd will say it's just a spike. The institutions will act like it's normal, while they quietly adjust exposure behind the curtain. And the payoff in this video is simple. I'm going to show you the hidden mechanism that makes this move make sense, why it's happening right now on the calendar, the levels that actually matter next week, and the specific signals that would confirm it or rip the thesis apart. Because if one level breaks, the math changes. Here's the cleanest way to frame what happened overnight. Gold didn't just go up. Gold broke a behavioral pattern. It pushed through the kind of ceiling that usually rejects price and sends it back into a grinding range. And it did it with the kind of speed that forces people to make decisions they didn't want to make. That matters, because speed is information. Speed is what turns "I'll wait for a pullback" into "I'm getting left behind." And it's what turns "I'm hedged" into "I'm underhedged." And that's where the real pressure starts. The price context is not subtle. Early in the month, gold was trading around the low 40,300s per ounce. And by January 23rd, it had printed just shy of $5,000, around 40,188 per ounce, on widely tracked daily price histories. That's not a gentle grind. That's a month that forces a lot of portfolios to reevaluate what they thought their risk profile was. And here's the key. When you see a move like that, you don't ask, is it bullish? You ask, who is being forced to do what? Because markets don't move on opinions. They move on constraints. Now, let's translate breaks pattern into what it actually means in modern finance. Most money isn't discretionary anymore. A massive amount of capital is systematic. Trend followers, CTAs, volatility target funds, risk parity, quant overlays, even basic rebalancing mandates. These systems don't need a geopolitical headline to buy. They need a trigger. They need a level. They need a volatility condition. They need a correlation shift. And when a multi-week pattern breaks with momentum, those systems start leaning in, not because they believe in gold, but because their models respond to price behavior. That's why these moves feel like they come out of nowhere. They don't. They come out of models turning from neutral to long. And once that happens, the market stops being about your story and starts being about positioning. But here's the part that matters more than the chart. Gold didn't need nominal yields to collapse. It needed real yields to stop bullying it. Real yields are the after-inflation opportunity cost anchor that sits like a gravity field on non-yielding assets. When real yields rise, gold has to fight uphill. When real yields soften, even a little, gold stops fighting uphill. And suddenly the same flow that couldn't lift it yesterday can lift it violently today. And that's exactly the kind of quiet shift you get when the rate market starts blinking first. Let's do the mechanism clean, no mysticism. A real yield is basically the return you get after inflation in real purchasing power terms. If you can earn a strong real return holding safe paper, then gold has a tougher job because gold doesn't pay you a coupon. But if the market starts pricing lower real returns forward, because growth expectations soften, because policy expectations shift, because the inflation path gets repriced, because the term premium compresses, then gold's relative handicap shrinks. It doesn't need to become more valuable in some philosophical way. It just needs the alternative to become less attractive on a risk-adjusted, after-inflation basis. And once that happens, you don't just get investment demand. You get hedging demand. You get reserve demand. You get, I need something that isn't someone else's liability demand. And that's when price discovery changes. Now here's the hidden detail that reframes the whole story. And it's the one almost nobody on mainstream screens explains properly. For a huge portion of global capital, the real yield you think exists doesn't exist after hedging. If you're a non-US investor, say a reserve manager, a sovereign fund, a big institution that reports in euros or yen or another currency, you can't just look at a US real yield and say, great, I'll buy that. You have to think about the currency. If you hedge the dollar exposure back to your home currency, you pay hedging costs. Those costs are tied to interest rate differentials and, crucially, the cross-currency basis. In plain English, the headline yield on the screen is not the yield many global players actually get after doing the risk management they are required to do. So when US real yields soften, the effective hedged yield for foreigners can soften even more, or flip from acceptable to not worth it, especially if hedging costs are elevated. And when that happens, gold stops being the thing that yields nothing and starts being the thing that doesn't punish me for hedging. That's not a conspiracy. That's incentives. That's plumbing. And it's a massive part of why gold can rip while people argue about whether rates are still high. And the next detail is what flips the whole setup. Overnight moves aren't just drama. Overnight is when liquidity is thinner, when order books are less forgiving, and when stop clusters can get triggered with less effort. A move that happens in thin liquidity doesn't automatically mean it's fake. Often it means it's revealing where the pressure actually was. Because if price can travel that far when it's hardest to move it, what happens when the full day's liquidity shows up and the market has to re-hedge into it? That's where reflexivity shows up. And reflexivity is not a buzzword, it's the engine. So let's talk options. Because if you want to know whether this move can cascade, you watch the options market like a hawk. Here's the simple version. When traders buy calls, dealers often sell those calls. Dealers then hedge their exposure by buying the underlying futures, spot, related instruments based on the options delta. If price rises, delta rises, which can force dealers to buy more to stay hedged. That's gamma. Positive gamma can dampen moves. Negative gamma can amplify them. And in the wrong configuration, a breakout can turn into a feedback loop. Price up forces hedging buy. Hedging buy pushes price up forces more hedging buy. That's how you get those why is it still going days. And yes, gold can do this too, especially around key strikes and expirations. But that's not the part that matters most. The part that matters most is timing. Because the calendar is the catalyst, and it's stacking pressure right now. You've got weekend gap risk, where positioning goes home and comes back to a different market. You've got a major Federal Reserve meeting on January 27th, 28, which is exactly the kind of event that reprices real yields and the dollar in a heartbeat. And you've got a key gold options expiration tied to late January. CME's calendar for the February 2026 gold option contract shows last trade and settlement on January 27. That means you're walking into a window where hedges roll, exposure gets neutralized or rebuilt, and price can get pinned or launched depending on where the open interest sits. And when you combine thin liquidity moments with event risk and option mechanics, you get a market that can move faster than people think is reasonable. But markets don't care what feels reasonable. They care what is forced. Now let's stack proof, because we're not doing one argument hype. Proof point one is the chart structure itself. The market broke out of a behavioral range and held above it, which tells you sellers who used to defend that area are either out of ammo or no longer motivated. Proof point two is the real yield context. Late January data shows the 10-year tips real yield easing into January 22, which is consistent with the opportunity cost pressure softening. Proof point three is the institutional behavior. Major banks are publicly discussing higher gold targets and highlighting demand sources like central banks, which matters not because banks are profits, but because that kind of messaging tends to follow flow and justify flow, especially for clients who need a narrative to allocate. Proof point four is the calendar itself. Event risk plus expiration windows are exactly when you see forced hedging flows and systematic adjustments. Proof point five is cross-market psychology. When gold starts ripping toward big round numbers like 5,000, liquidity often thins because nobody wants to be the one fading it too early, and shorts become nervous about gap risk. And nervous shorts buy back. Even if they're right later, they buy back now. That's the market. Now, we need to address the commodity supply side in a way that doesn't insult your intelligence. Gold is a weird commodity because high prices cure high prices works poorly in the short run. If copper spikes, you can sometimes get scrap flow and supply responses that show up relatively fast. With gold, mine supply changes slowly. New projects take years. Recycling can rise, but it's not infinite, and it's often price sensitive in a non-linear way. People don't melt their family jewelry because price moved 2%. They do it when price hits a psychological threshold and stays there. Meanwhile, most gold is already above ground, which means the flow dynamics matter. Who is willing to part with it, at what price, and under what stress? That's why gold rallies can be sticky. They're not just about new supply, they're about withheld supply. They're about people deciding, actually, I don't want to sell this yet. And when the marginal seller steps back, price can jump to find the next seller. That's literally what markets do. And this is where we talk paper versus physical without turning it into a cartoon. You don't have to claim manipulation to see tension. You watch deliverable dynamics, you watch term structure, you watch spreads, you watch whether the market is paying you to hold metal now or later. In commodities, the curve tells stories. Backwardation, and where near-term prices are higher than future prices, can imply tightness or urgency. Contango, where future prices are higher, often implies ample supply and storage costs. Gold is often in contango because of financing and carry, but when those relationships change, or when certain spreads get stressed, it's a signal that participants are paying up for immediacy or scrambling for specific liquidity. And even if you don't have every inventory number memorized, you can still think in categories. What's deliverable? What's eligible? What's registered? What's actually available for settlement? Markets can look liquid until they aren't. And the moment the market suspects that available is less than advertised, the behavior changes. But here's the key. You don't need a dramatic narrative. You need to understand incentives. If people feel they might need metal now, they pay up now. If they think they can roll it, they don't. That's it. That's the mechanism. Now zoom out globally, because if this were just a dollar story, it would behave like a dollar story. The tell with real regime shifts in gold is when it starts making highs across currencies, not just in USD. When gold is strong in euros, in yen, in pounds, and in local currencies, the message is broader. It's not the dollar is weak. It's the system is repricing safety and purchasing power. That's why central bank demand matters so much. Central banks don't buy because of a YouTube thumbnail. They buy because of reserve strategy, sanction risk, geopolitical hedging, and long-term diversification away from any single issuer's liabilities. And when you have that steady bid underneath the market, it changes the behavior of dips. Dips stop being opportunities to short. They become opportunities to buy what someone else is trying to accumulate. And that's where the real pressure starts again. But let's not turn this into one-sided propaganda. The market can absolutely punish complacent bulls. So here's what could break the thesis fast. And I want you to actually internalize this, because this is where credibility lives. If real yields snap higher, if the market reprices the Fed path hawkishly, if inflation expectations drop faster than nominal yields and real yields jump, gold can get hit hard. If the dollar rips, if there's a sudden flight into dollar liquidity, if global risk cracks and the dollar becomes the least dirty shirt, gold can stall or even dump, especially if leveraged players are crowded long. If we get a broad deleveraging event, margin calls, forced selling, sell what you can, not what you want, gold can get sold temporarily, even if the longer-term story remains intact. And if the breakout level fails, if price breaks back down into the prior range and can't reclaim it, that's a classic bull trap. The market loves bull traps because bull traps create forced sellers. And forced sellers are fuel. This is also where I need to hand you a psychology shield, because the market is going to try to manipulate your emotions with volatility, and it's not personal, it's structural. Volatility is the tax you pay for being right early. The market will whip around violently even if the thesis is correct. That's not a bug, that's a feature. Because the market's job is not to reward your prediction. The market's job is to transfer risk from those who can't hold it to those who can. And it does that by creating pain. It shakes out weak hands. It punishes late entries. It makes you feel dumb for buying, then makes you feel dumber for selling. The way you win is by separating trend signal from noise. Trend signal is structure. Breakout holds, higher lows, real yield support, flows that persist across sessions, dips that are bought quickly. Noise is intraday drama, headline spikes, random dumps, and thin liquidity, 1-hour reversals that mean nothing if the weekly structure stays intact. And if you can't tell the difference, the market will use you as liquidity. That's the harsh truth. So let's get tactical. What comes next in the next week or two isn't a mystery if you know what to watch. First, the big psychological zone, $5,000. Markets love round numbers because humans love round numbers, and that's where positioning clusters. If gold can hold near that zone, or break it decisively and then treat it as support, that's a major confirmation signal. If it tags it and rejects hard, that doesn't end the bull thesis by itself, but it raises the probability of a pullback and retest. Second, watch the breakout shelf. You don't need a perfect tick. You need a range. Think in zones. The upper 4,800s to low 4,900s area is where the market accelerated. If gold pulls back into that area and buyers show up quickly, tight candles, fast reclaim, strong bids, that's a classic bullish retest. If it slices through it like it isn't there and struggles to get back above it, that's the market telling you the breakout was more fragile than it looked. Because if that one level breaks, the math changes. Third, watch real yields and the dollar around the Fed window, not the headlines, the reaction function. The market can rally on a hawkish statement if it was priced for worse, and it can sell on a dovish statement if positioning is stretched. What matters is how real yields respond. If real yields continue to ease or stay capped while gold holds its structure, that's supportive. If real yields jump and gold can't shrug it off, that's your warning light, and you don't need to be perfect. You just need to be honest about what the market is doing. Fourth, watch options-driven behavior into and after January 27th. When options expire, hedges change. Pinning can happen where price gravitates toward large open interest strikes, or you can get the opposite. Once expiration clears, the gravity releases and price moves more freely. If gold has been constrained below a level and then suddenly clears it after expiration, that can be a clue that the dealer hedging regime just changed. If gold gets slammed into expiration and then immediately rebounds, that can be a clue that selling pressure was mechanical rather than fundamental. And that's the kind of nuance mainstream takes never cover. Now I'm going to give you the two scenario lens, because this is the simplest way to stay sane and avoid being emotionally hijacked. Scenario one is the controlled pullback and retest. Gold tags the big zone, pulls back because it's stretched, maybe because real yields wobble or because traders take profit into an event, and then it finds support at the breakout shelf and builds a higher low. In that scenario, the trend signal remains intact, and the pullback is the market doing what markets do, resetting leverage, letting late buyers get a second chance, and preparing for the next leg. The confirmation there is simple. Dips get bought quickly, and the structure holds. Scenario 2 is the continuation squeeze with gap risk. That's the one where gold doesn't give people the pullback they want. It chops briefly, then launches through $5,000, and the move accelerates because shorts get trapped and dealers chase hedges. In that scenario, the risk isn't, I missed it. The risk is, I chased it at the wrong time and got shaken out. Because squeeze markets don't trend politely. They sprint, then they snap back, then they sprint again. And that's where your psychology shield matters most. If you're going to operate in that environment, you respect volatility. You size appropriately. You don't confuse adrenaline with edge. And you remember, you can be right on direction and still lose money on execution. So what would invalidate the bullish setup near term? I'm going to keep it clean. A failure to hold the breakout zone after multiple attempts, especially if real yields are rising, would be a meaningful warning. A sharp real yield spike combined with a strong dollar surge would be a serious headwind. And a breakdown back into the prior range with no quick reclaim would suggest the market was ahead of itself and needs more time. None of those mean gold is dead forever. They mean the timing and the path changes. And path is what costs people money. Now let's circle back to that hidden detail because this is the part you should hold in your head when the narrative noise gets loud. The global investor S real yield is not the US screen yield. It's the yield after hedging, after basis, after constraints. And that's why gold can move when TV pundits say, but rates are still high. If the effective yield is lower than it looks, and if the market believes it will be capped or eroded, then gold's AES competitive position improves. That's the quiet structural undercurrent. It's not about one day's headline, it's about the incentive gradient underneath the market shifting. And once that shifts, price action stops being a mystery and starts being a map. Here's the final piece you need, and it is a warning and a strategy rolled into one. Volatility will be used against you. The market will try to make you emotional at the exact wrong moments. It will dump on a good news and pump on bad news, because it is hunting positioning, not logic. If you want to keep your edge, you anchor on three things: structure, mechanics, and calendar. Structure, does the breakout hold? Mechanics, what are real yields, the dollar and options flows forcing participants to do? Calendar, what events and expirations are compressing decisions into a short window? If you keep those three in focus, you won't get hypnotized by the noise. And if you're still with me, here's the simple checklist for the next week. Watch $5,000 behavior. Watch the breakout shelf in the upper $4,800 to low $4,900. Watch real yields into and out of the Fed window and watch post-expiration behavior around January 27. If gold holds structure while real yields stay soft, the market is telling you the trend signal is alive. If real yields spike and gold starts failing breakouts, the market is telling you the squeeze fuel is fading. Either way, you're not guessing, you're reading. One last thing before we close. Don't outsource your conviction to the loudest voice. The point isn't to be a gold maximalist or a gold skeptic. The point is to be a structure-first operator. When the pattern breaks, you don't argue with the market. You ask what the market is forcing. And right now, the market is forcing a lot of players to admit that the old relationship, real yields up, gold down, is not a law of nature. It's a tendency. And tendencies break when incentives change. If you want to stay sharp in this kind of tape, stick around this community. Not because you need another opinion, but because you need a place that respects mechanics over headlines and risk management over bravado. We're not here to get hypnotized. We're here to see the pressure points before they pop. Because the next detail is what flips the whole setup, and the market is about to show it.